Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly podcast. Today's date is the 25th of May. Let's dive into the week's top market news. European equities surge as Eurozone braces for growth downgrades. Over the past week, European stock markets recorded a highly positive performance, driven by growing optimism regarding a possible de-escalation of geopolitical tensions in the Middle East. The Pan-European Stocks Europe 600 index closed the weekly session up 3.00% in local currency terms. Among the continent's major financial hubs, the German stock exchange led the gains with the DAX rising by 3.92%. Followed by the UK's FTSE 100, which climbed 2.66%, and France's CAC 40 index increasing by 2.05%. The progress of Italy's FTSE MIB was more contained but still positive, registering an increase of 0.80%. Despite the favorable reaction of the equity markets, the broader economic picture presents elements of criticism and uncertainty. The European Commission recently revised downward its economic growth forecasts for the Eurozone for 2026, bringing them to 0.9% compared to the 1.4% registered in 2025 and below its previous estimate of 1.2%. This slowdown is attributable to a significant energy shock and an already volatile geopolitical and trade environment. In parallel, the Eurozone inflation forecasts for 2026 were raised to 3%, a value significantly higher than the previous estimate of 1.9%. In this context of price pressures, Germany recorded a 1.7% increase in producer price inflation in April, reaching its highest level since May 2023, driven largely by intermediate goods, mineral oil prices, and capital goods such as machinery, although a decline was observed in the prices of non-durable goods such as butter and pork. On the international trade front, the Eurozone saw its trade surplus contract sharply, dropping to €7.8 billion in March 2026, down significantly from the €34.1 billion registered in the same month of the previous year. This contraction reflects a steep slump in exports, particularly to the United States, which fell by 38.8% year-on-year due to the impact of U.S. tariffs introduced in April 2025. The sectors hardest hit by this decline include chemicals, machinery, vehicles, and the food and drink industry. Concurrently, the United Kingdom shows mixed signals. On one hand, the labor market exhibits deterioration, with the unemployment rate rising unexpectedly to 5% in the 3 months to March 2026 compared to the 4.9% recorded in the previous period, and job openings falling by 3.9% to 705,000, marking their lowest level in 5 years. On the other hand, news on the British inflation front proved better than expected, slowing to 2.8% in April from 3.3% in March, lower than the 3% expected by analysts. The Office for National Statistics highlighted that an energy price cap introduced by the country's regulator helped to keep a lid on inflationary pressures. Now our insight into alternative markets. Recordati heading for delisting. Anatomy of a consortium deal and signals of consolidation in European pharma. The offer launched by CVC Capital Partners together with Group Bruxelles Lambert for Recordati represents a highly compelling case of a consortium-based leveraged buyout, not only because of its size, over €10.7 billion in equity value, but above all due to its underlying financial and industrial structure. This is not a simple tender offer aimed at delisting. Rather, It is a transaction designed to enable a phase of strategic transformation that would be difficult to pursue under the constraints of public markets. The starting point is CVC's existing position, which already controls approximately 46.8% of the company through a dedicated investment vehicle. This is a crucial element. The deal is not driven by a hostile or opportunistic approach, but rather represents the natural evolution of a long-term investment. CVC has deep knowledge of the asset, has already influenced its governance, and is now aiming to complete its privatization to accelerate its development. The real innovation lies in the creation of a consortium. CVC is not acting alone, but is partnering with GBL and a group of institutional co-investors, including Abu Dhabi Investment Authority, CPP Investment Board, other funds, and the Recordati family itself. This consortium structure reflects three typical dynamics of large-scale private equity transactions. The first is risk-sharing. A transaction of this magnitude, in a highly regulated and capital-intensive sector such as pharmaceuticals, carries significant risks related to pipeline development, R&D, and pricing. Distributing equity among multiple investors reduces risk concentration on a single balance sheet. The second is capital optimization. GBL, for instance, commits only a limited portion relative to its NAV, while CVC retains the role of lead sponsor. This enables the construction of an efficient financial structure, combining control capital, co-investments, and likely leverage, without overexposing any single investor. The third is strategic alignment. The presence of long-term institutional investors and the founding family reduces the risk of misalignment during the post-acquisition phase. In transactions of this kind, governance is just as critical as financial structuring. From a valuation standpoint, the offer of approximately €52 per share, including dividends, implies a premium compared to pre-announcement levels but remains broadly in line with current market prices. This is a clear signal. This is not an aggressive transaction based on price arbitrage, but rather a consensual deal where the real value lies in future execution rather than entry pricing. The core of the transaction is industrial. Delisting allows Recordati to move away from short-term market pressures and pursue a more intensive strategy focused on R&D investment and, above all, M&A. The rare diseases segment, already identified as a strategic growth driver, requires targeted acquisitions, pipeline integration, and long-term horizons, dynamics that are often incompatible with public market volatility. This is where the most relevant insight for investors emerges. The broader systemic signal. The European pharmaceutical sector, particularly mid-cap specialty players, is entering a phase of consolidation. Many companies, while possessing strong assets and capabilities, lack the scale required to compete globally, especially in terms of R&D investment capacity, international market access, and bargaining power with healthcare systems. Private equity is increasingly targeting this structural inefficiency. Transactions like Recordati point to a clear strategy: acquire solid yet subscale platforms, take them private, aggregate complementary assets, and build larger, more competitive players through a buy and build approach. In this context, consortium structures become a key tool to mobilize significant capital and support ambitious industrial plans. In other words, this is not just a deal, it is a pattern. The beginning of a cycle in which financial and industrial players collaborate to reshape the European pharmaceutical landscape, bridging the scale gap with global leaders.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.